Introduction of Millennial Money Book Summary. Are you young and thinking retirement is far away? Think again. The truth is, the earlier you start planning, the better your future will be. Waiting means missing out on time's biggest gift, compound growth. Millennials born between 1980 and 2000 face a tough future if they ignore this. Do you want to struggle in retirement? Probably not. The solution is simple. Invest in the stock market. Patrick O'Shaughnessy explains how young people can build wealth. You don't need to be rich to start. You just need the right knowledge and a smart plan. This video breaks it down step by step. Discover how small actions today can create big results tomorrow. Learn how to invest wisely, grow your money, and secure your future. Don't miss out. Watch till the end to change your life. This video, including its audio and script, is protected by copyright. Unauthorized reproduction, distribution, or piracy is strictly prohibited and may result in legal action. Welcome to Money and Investment English Book Summary, Episode 3. In this episode, we'll explore 2014 published book Millennial Money, written by Patrick O'Shaughnessy. The full title of the book is Millennial Money, How Young Investors Can Build a Fortune. Chapter 1 of Millennial Money Book Summary. Start investing early. Want a secure financial future? Start investing in the stock market as early as possible. Think about your life 50 years from now. Do you want financial freedom or do you want to struggle with a small pension? The answer is clear. To achieve financial stability, you need to make smart choices today. Many believe that saving money is the best way to prepare for the future. But savings accounts don't always help. The interest rates are usually lower than inflation. This means your money loses value over time. So what's the better option? Investing in the stock market. Starting early gives your money more time to grow. For example, if you invest $10,000 every year and get an average return of 7%, you could have $4.7 million by age 65 if you start at 22. But if you wait until 40, you may end up with just $1 million. That's a big difference. Despite the benefits, many young people don't invest. One reason is fear. The 2008 financial crisis made millennials cautious. A survey in 2014 showed that only 28% of millennials' money was in stocks, compared to 46% for older generations. But avoiding the stock market means missing out on long-term gains. The sooner you start, the better your future will be. Don't let fear stop you. Invest early, stay consistent, and secure your financial future. Chapter 2 of Millennial Money Book Summary. An uncertain future ahead. Millennials face an uncertain financial future. Rising public debt and an aging population are big problems. Many people think they don't need to invest for retirement because they expect a pension. But what if there isn't one for them? This is a real concern. The population in America is getting older, and this increases the cost of pensions for the government. In 1900, life expectancy was only 47 years, but by 2013 it had risen to 79 years. More people are living longer, even past retirement age. As a result, the government has to spend more on pensions and healthcare. For example, Medicare costs have been growing by 11% each year since 1966. The situation is likely to continue, especially with the baby boomer generation, born after World War II, starting to retire. These rising costs for healthcare and retirement are a big problem. Because of this, there's no guarantee that the government will continue to provide benefits for future generations. The government is like a business. If it doesn't balance its budget, it could go bankrupt. The government needs enough tax revenue to cover its spending, but right now, it's not happening. Recent calculations show a $9.6 trillion gap between what the government will spend on benefits over the next 75 years and what it expects to earn from taxes. For millennials, this is a big issue. They are paying taxes now to support older generations, but they might not get the same benefits when they retire. This means millennials will likely have to support themselves without help from the government. To prepare for this, millennials should start investing early, especially in the stock market. It's important to take control of their own financial future. Chapter 3 of Millennial Money Book Summary. Smart Investing Tips. If you want to build wealth for the future, invest in stock markets worldwide. Many new investors only buy stocks from their own country. This can be risky. If that country's market crashes, they could lose a lot of money. A good example is Japan's stock market. In 1989, it was booming, growing at 30%. But this growth was a bubble. When it burst in 1991, investors lost big. By 2013, their money was worth half of what it was in 1989. This shows why putting all your money in one place is dangerous. Yet many people still do it. Why? Some get caught up in stock market hype. Others invest in companies they know, like Burger King or General Motors. In 2010, Americans had 72% of their money in US stocks. A smarter strategy is to invest in different countries and industries. This reduces risk. If one market fails, your other investments can balance the losses. Plus, it can help you make more money. For example, if you invest in Samsung, a South Korean company, and the South Korean currency strengthens by 6% against the US dollar, your investment grows by 6% too. Investing globally means you're not just buying company shares, you're also benefiting from currency changes. The key to smart investing? Don't put all your money in one place. Spread it out, think long term, stay patient. That's how you grow your wealth. Chapter 4 of Millennial Money Book Summary. Smart Investing Secrets. If you want to make more money, don't follow what everyone else is doing. Most people invest the way experts tell them to. One popular method is the sector leader strategy. This strategy means buying shares of the top companies in a market index. For example, the S&P 500 tracks the biggest companies in the stock market. You can invest in an index fund, which includes shares from these 500 companies. Index funds are simple, low cost, and safe. They are good for steady returns. But if you want the highest returns, don't follow the crowd. Index funds only match the market, they never beat it. Also, big companies often slow down after they grow too large. Companies like Apple and Intel have seen their growth drop after reaching $400 billion in value. Instead, try a different strategy. The sector bargain strategy focuses on buying cheap stocks, not the best ones. This may seem strange, but history shows it works better over time. Since 1979, the Russell 3000 index, which follows a bargain approach, has grown 1,100% more than the S&P 500. If you want bigger profits, think differently. Investing in undervalued stocks can bring better results than sticking with big-name companies. Smart investing means looking for hidden opportunities, not just following the crowd. Chapter 5 of Millennial Money Book Summary. Smart Investing Made Easy. Want to make smart investments? Use a strategy that combines good selection rules. The best way to invest is to be different. Let's break it down simply. A great investment strategy is called the Millennial Money Strategy. The idea is simple: buy cheap stocks from valuable companies. Why is this smart? Because buying cheap stocks helps you get more for your money and increases your chance of big future returns. But be careful. Cheap does not mean the lowest price. You must pick companies that have real value. The goal is to buy stocks that are undervalued now but will rise later. So how do you check if a company has value? Look at earnings. How much money does the company make? Check cash flow. Is the company making real cash or is it just using loans? Compare stock price to cash flow. This helps you find the best bargains. The key is to find companies with low prices and strong finances. But there's one more trick: momentum. This means buying stocks just as they start growing. A simple way to do this is to look for cheap stocks that have risen in price over the last 6 months. Using both value and momentum makes for a powerful investment approach. And history proves it works. Since 1972, stocks that meet these criteria have grown twice as fast as the overall market. So if you want to grow your money, find valuable stocks, buy them cheap and catch the momentum. Happy investing. Chapter 6 of Millennial Money Book Summary. Think before you invest. Don't let your instincts control your investment decisions. Human brains are wired to make mistakes when it comes to investing. We often act out of fear instead of logic. Scientists call this constructive paranoia. It means we are too sensitive to losses. A study from Stanford proved this. Students played an investment game where they had to decide whether to invest $1. A coin flip decided the result. Heads meant they lost $1, but tails meant they won $2.50. Logically, this was a good deal. There was a 50% chance of winning more than double the investment. But after a loss, students only invested 41% of the time. This fear of losing made them avoid good opportunities. This happens in the real market too. Many investors buy stocks when prices are high because they fear missing out. Then they sell when prices drop because they fear losing everything. This is the opposite of smart investing. Greed also leads to mistakes. People chase rewards even when the chances are very low. This is what causes financial bubbles. Investors rush to buy, thinking prices will keep rising, but eventually the bubble bursts and they lose money. You can't remove emotions completely, but you can control them. One way is to set up an automated investment plan. You can arrange for a fixed amount of money to go into your investment account regularly. Choose a fund in advance and stick to the plan. This way, your emotions won't interfere and you'll follow a steady strategy. Investing based on logic instead of emotions can help you avoid common mistakes. Stay consistent, automate your investments, and don't let fear or greed take over. Chapter 7 of Millennial Money Book Summary. Think long, earn more. Long-term thinking leads to profitable investment. Many new investors panic when their stocks lose value. They sell too soon. But this short-term thinking usually results in losses. Why do people think short-term? Our brain is partly to blame. The limbic system controls emotions and makes us seek quick rewards. This is why during financial crises, many investors buy bonds instead of stocks. Bonds seem safer because they don't drop in value as much as stocks in the short term. This makes investors feel secure. Even professional investors fall into this trap. They focus on short-term gains to impress employers. They design investment plans that show results in 2 to 3 years. But data shows that real profits come from long-term investments. Stocks need about 30 years to grow significantly. Although markets go up and down, the long-term trend is usually upward. Looking at history, stocks lose value 31% of the time in 1-year periods. But over a 20-year period, stock indexes never lose money. Bonds, however, lose value half the time over the same period. The lesson? Patience pays off. Think long-term. Stay invested. Let your money grow. Conclusion of Millennial Money Book Summary. Thank you for watching this video. We explored key ideas for a secure financial future. The advice is clear and simple. Start investing in the stock market early. This is very important. The book shows you how to do it. You must act now. Invest in stocks today. Use a few simple rules. First, diversify your portfolio. Buy stocks from many countries. Spread your risk. Next, stick to your strategy. Do not follow the crowd. Trust your own plan. Lastly, make smart, bold choices. These steps help you build wealth over time. Follow these tips to succeed. Your future is in your hands. Thank you for watching and learning with us today. Disclaimer, please check the description. Any digital copy of this content that is shared through piracy or downloaded without permission or uploaded on any online social media platform will be considered a clear violation of copyright law. Piracy is a serious offense and strict legal action will be taken against it. Additionally, copyright infringement may result in a strike against your YouTube channel or page, and it could even be deleted. Therefore, please do not engage in piracy or support it. This content has been created based on the references from the mentioned book. However, it may contain some unintentional errors or inconsistencies due to human or mechanical mistakes. If you notice any mistakes or inconsistencies, please accept our apologies and inform us through a comment or message. If you enjoy this book summary and wish to gain complete knowledge of the book, then please consider purchasing the book from an online or offline bookstore and reading it.